Hey ROC board members, time for another video. This time we're going to talk about the different types of bank accounts that your ROC has and how to understand how they work and what's going on within them. It's obviously a very important thing for a business to understand is the bank accounts and the bank balances. So we're going to go over an overview of 5 different bank account types that your ROC might have, and we're going to try to answer the who, what, how much, when, and why behind each of these 5 accounts. In other words, who holds the account? Is it the ROC itself or the lender? What they're for, what they are and what they're for, how much money goes into them, any minimum balance requirements if there are any, and when are deposits usually made into these accounts. So we'll do that in the first half of the video, is answering those 4 questions, and then we'll do the second half of the video on learning to drill down and understand why things are happening within those accounts. So let's get started. Okay, account type number 1 is your replacement reserves. I've already done a video that goes into a bit more detail on this account type before, so I'll take the link to that video and place it in the description below. But for the purposes of this video, the overview goes as follows. Who holds the account? It is usually, in this case, your lender, to make sure that they're keeping an eye on how much you're saving to pay for these big capital improvement projects. And to use money from this account, your ROC would usually have to submit a replacement reserve request to the lender for them to then cut a check to pay for items out of this account. What is it for? This account is for saving up for and paying for big capital improvement upgrades throughout your community: water projects, sewer projects, electrical projects, and so on. How much money goes into this account? There's not a specific amount set in your loan agreement or anything like that. However, every year when your members pass a capital improvement plan as part of its budgeting process, usually your lender also approves the capital improvement plan and budget. That capital improvement plan has an end of year replacement reserve balance amount. So your goal is to try to stick with that budget and finish out the year with that minimum balance or more in it. So that's kind of your minimum balance amount, is look to your capital improvement plan for the year and see what your balance set by that plan is. When are deposits made? There's a monthly amount that your lender will withdraw from your operating account and put into reserves. And then on occasion, members might vote to move some surpluses from a year at the end of the year into the account. So those are the 2 ways that replacement reserves get deposits made into them. All right, account type number 2 is a tax and insurance escrow. Now, those of you that have a home mortgage, you're probably familiar with how this works. But for those that don't, it's pretty straightforward. Who holds the account? In this case, with this type of account, it's the lender that holds the account. What is it for? It's for paying the annual insurance premium and the sporadic tax bills that are paid throughout the year. Since those bills are pretty pricey, the idea is that the lender takes monthly withdrawals from your operating account, your ROC's operating account, and then makes sure that there's enough of a balance throughout the course of the year to pay the insurance and the tax when they come due. And how much money goes into the account? This is something that the lender will calculate on their own to just make sure that there's always enough money in for when the bills are due. So occasionally they'll send you a notice that they need to make adjustments or make one-time deposits into that account just to make sure everything works, but it's pretty much an automated process on their end. And like I've already pretty much said, monthly the lender will move fixed amounts from your operating account into this escrow, but occasionally, to make sure that everything's able to be paid, they'll do some extra correcting deposits. All right, account type number 3 is called your debt service escrow. This is an account held by your lender, and this is for emergency mortgage payments. So if you're in a situation, you're in a rough patch, your main operating account balance is low, this account is available to be able to pay a mortgage payment or 2, depending how much goes in there, to give you the time to figure out a way to navigate through the challenge you're going through. And because it's held by your lender, you're going to have to explain the problem, explain your plan to get out of the problem, and then you can use money to buy yourself some time. This amount for your ROC will be set at your loan agreement, but it's usually a month or 2 months worth of a mortgage payment that just sits in an account, collects a little interest, and is available only in these worst case scenarios. They're very infrequent. In fact, I've only seen ROCs use this account once or twice before in many years of doing this line of work. So hopefully you never have to touch it. You can always talk to your TA provider or your lender if you're having trouble finding the minimum balance requirement in your loan agreement. And unless you use this money to get out of an emergency, no deposits are ever made into this account. It just sits there, collects interest. Only in a case where you go through an emergency, use money out of here. When you're recovered, then you'd have to make a deposit into this account to get it back to its minimum balance. All right, account type number 4 is called your working capital account. This is an account that's usually held by your ROC, and it is essentially a backup checking account. You can pretty much use it for whatever expenses when you need it, but there is a minimum balance requirement usually set in your loan agreement. So either check that document or talk to your TA provider or your lender to see what your minimum balance is. But it's usually set by around a month and a half of your budgeted operating expenses at the time of purchase, just to have this backup reserve in case you're having a rough year. You have an account to draw into to pay for some expenses before you go into that emergency debt service fund that we looked at prior. So this is like your first line of defense after your main operating account. And usually no deposits are made into this account unless you want to, your membership wants to, or in the case of, say, you used money out of this account when you're in the position to do so, to replenish, to put money back into this account to get it to its minimum balance. All right, account type number 5 is your main operating account, which is obviously held by your cooperative, and it is for collecting and depositing lot rents into to pay for all the month-to-month, day-to-day operating expenses to run your community. So your plow bill, your trash bill, your mortgage payment. And there isn't a minimum balance requirement per se. However, you want to have enough money in there to pay all of your basic operating expenses and your mortgage. So I would say at a minimum, keep 1 month of budgeted income in there, but it's much safer to have 2 months. Two months cushion just sitting there to pay for things just in case something bad happened. You're covered. Plus you'll have the working capital fund put aside that we talked about already, and then the debt service fund. So shoot for 2 months of minimum balance if you can. Also, there is a requirement, even though it's not for a minimum balance, to grow the balance of this account over the course of a year, which is called a debt service coverage ratio. I'll do a separate video on that. There's a specific formula for that, but basically what it means is over the course of your fiscal year, you want to grow the balance of your operating account by 10% of your annual mortgage payment. So if your annual mortgage payment is $100,000, you'd want the balance of this account to grow by $10,000 over the course of the year. It doesn't mean you have to grow the account every single month. There's going to be some months that are worse than others, like winter months, for example, but over the course of the year, you should have this account growing by 10% of your mortgage payment. This debt service coverage ratio requirement's in place just as another safety mechanism to make sure that you have some wiggle room if for some reason you have a bad string of months. It's giving you a little bit of buffer to be able to weather those kind of storms. And the good news is that after the end of the fiscal year, if you have grown your account that much, you can use those funds to reinvest in your co-op. Generally speaking, most co-op memberships vote to move the surplus that's grown in this account over the course of the year into their replacement reserves to take on some big capital improvement upgrade projects. But that can't happen until you've gone through the year and shown to your lender that you've actually hit the target and grown your operating account balance. All right, now that we've done a brief overview of the 5 different account types, the next part of this video is looking at drilling down to understand the why behind why these account balances might be changing from month to month, to understand the backstory of why those balances are changing. So it's a pretty simple process, and it starts by when your financial packet comes out every month, take a look at the balance sheet, which will show what the balances of those 5 different account types are for the end of that month. And we'll take a look at a sample, but these account balances will be listed at the very top of the balance sheet report, which should be the very top of your financial packets. And then a limitation of the balance sheet, it just shows balances as of one point in time, but I generally encourage boards and treasurers to take some of the key data from those reports and put it onto a spreadsheet called the trending report, so you can track, among other things, the balances of those 5 account types month over month over month, so you can spot trends, hence the name trending report. You can see if balances are growing or shrinking. So that's the next step, pretty easy. From there, to really understand why an account might be going down or going up, I recommend taking a look at the general ledger, which is probably going to be the largest report in your financial packet, and it's usually halfway down. But the information there is super valuable, and the information on these accounts, these 5 account types, will all be at the very, very top of this report, and we'll take a look at a sample so you can see how to make sense of this very valuable report. And then lastly, if necessary, if you want to go verify some of the information that was on the balance sheet or the general ledger, you can go to the statements themselves. In the case of the accounts that are held by your lender, those details will be on the loan statement that the lender produces every month, and that should be in your financial packet provided by your property manager every month. And then for the accounts that are held by your co-op itself, those details will be in the bank statements, which are also towards the bottom of your financial packet. So let's take a look at a sample co-op and see how to understand some of these details. Okay, let's take a look at step 1, looking at the balance sheet. This is a real set of financials with the co-op's name removed from August 2020. And towards the top of the financials, you'll find the balance sheet. And I'll do a video on more parts of the balance sheet at another time, but for the purposes of this video and tracking bank balances, you can see the 5 account types we mentioned in this video listed at the top of the balance sheet, and the balances are provided as of this end of month time period, so August 31st, the balances of these accounts. All right, the next step is to take the data from that balance sheet, which has those 5 different account type balances listed, and to put it on to a spreadsheet that we call the trending report. And if your co-op doesn't have one of these, talk to your TA provider about getting set up with one, because it's super valuable. You can see here that it's tracking a number of key things, but down here towards the bottom, what the treasurer for this co-op does is takes those 5 account balances as of the end of each month and places them on this sheet, so that over time you can track and see whether the accounts have gone up or down. And in this case, looks like all of the accounts pretty much either stayed the same or went up, so that looks good. All right, step 3 is to go through your financial packet for the month and hunt down the general ledger report, which, as I already mentioned, is probably your longest report, 10 plus pages in the financial packet. But the very top page has lots of very useful bank account information. So let's take a look. Here you can see the main operating account activity, the working capital account activity, tax and insurance escrow, debt service account, and replacement reserve account. All 5 accounts and all their month details of activity provided on the very first page of this report. So it's super handy. Reading this report is pretty straightforward. You have all the different transactions out of the account listed and the date of the transactions. Check numbers would be provided here. The names of the vendors who the checks are written out to would show up here. I've removed some of those for this video. Some memos provided by the property manager might show up here. And the key columns to pay attention to are these 2 right-hand columns. The far right-hand column shows the running balance throughout the month for these various accounts, and the top right of each section shows the start of the month, or in this case, August 1st's balance here. And then the bottom right of the section shows the end of the month, or August 31st balance here, and this number equals the number provided on the balance sheet that we looked at prior. So you can see how this account changed over the 31 days of August. And then this column here, what you need to know is that anything that's an expense, money taken out of the account, will have a negative in front of it, and then anything that doesn't have the negative in front of it is a deposit. So this is the operating account, so all these positive numbers are deposits of lot rent. And then negative numbers are various expenses. You can see a big one here, $14,462. That's the mortgage payment and transfers to some of the escrows withdrawn in one check. So this same procedure applies to these other different account types. Like you can see, for example, here, the tax and insurance escrow had a little deposit of $286.50 made into it. There was also $2.12 of interest added to this account, so you can see the details of why this account balance went up, for example. So super valuable report. Take a look at it. It's pretty easy to read once you get the hang of it. Step 4, which we won't have time to look at an example of in this video, is again for accounts held by your lender, look to the bank statement included in your financials, and for accounts held by your co-op to look to the bank statements also included in your financials, just to verify the numbers that you're seeing on the balance sheet and the general ledger. Thank you everyone for watching, and until the next video, rock on.